Good afternoon, everyone, especially to all our viewers who are either present in the virtual room today or on Facebook or Twitter. Thank you so much for joining us today on the third and last day of our annual virtual conference. Over the last 3 days of our Emerging Ideas Conference 2020, we have had global and Indian experts across the domain of investment and finance come on this forum and share their knowledge and wisdom with us. Now we all know the kind of times we are going through. Global economy is still in a mode of recovery, but equity markets across the globe recovered so fast and offered returns way beyond what most of us were expecting. Indian equity market is actually the second highest return generator after Canada since the bottom was made in March. Now, on one side, we have pandemic uncertainty still looming large on our heads. And on the other side, most of the stocks are trading at unprecedented valuations. In such a scenario, stock selection capability will be of utmost importance. And with this note, I thought it's important to bring in two famous voices on stock picking and money management in India today. Let me welcome Mr. Sunil Singhania on this forum. His name is so popular in the field of investment and fund management that he needs no introduction. Mr. Singhania founded Abakkus Asset Management in 2018, and within a short span of time, the fund has accumulated AUM of almost 3,000 crores. Such tremendous growth in such a challenging time depicts the goodwill Sunil enjoys and is very well earned in almost 2 decades long industry experience. Investors have known Sunil for his alpha generating stock picking capabilities across sectors and across market cycles. And under his leadership, Reliance equity schemes rated amongst the best, and Reliance Growth Fund grew over 100 times in less than 22 years. He is also the first individual from India to be elected as a member of the CFA Institute Board of Governors. He has sat on CFA Institute's Standard of Practice Council for 6 years and was the founder of CFA Society India and has served its president for 8 years. Let me also welcome Mr. Samit Vartak, founding partner and CIO of SageOne Investment Advisors. I have personally known Samit for the last 10 years now and have experienced a large part of his successful journey from a humble beginning in a small village to CIO of one of the most sought-after fund managers in India. Samit is regarded for his investing wisdom, thought process, discipline, superior performance, and above all, his integrity. He started accumulating AUM in 2012 when it was 1.3 crores, and the number in last 7-8 years has jumped over 1,300 crore today. This includes both domestic and international funds. Today, SageOne is considered one of the top performing funds in the last decade by PMS AIF World with a CAGR of almost 25%. Samit is a CFA charter holder and has done his MBA from Collins School of Business, Washington University. He has completed his engineering from Sardar Patel College, Mumbai University. Samit has spent a decade in US working initially in corporate strategy with Gap Inc. and PwC Consulting, and then with Deloitte and Ernst & Young, advising companies on business valuations and mergers and acquisitions before returning to India in 2006. Sunil and Samit, it's a pleasure to have both of you with us today. So Sunil, if I were to turn to you for my first question, stock picking is a very difficult game and very strongly driven by a process. So what are the key pillars of your investing and stock picking style?
Thanks for having me here, Vinay, and thanks everyone for joining us on this virtual conference. Obviously, the question you've asked, I don't know how to answer it in a very short period of time. But one is, I think, the processes evolve. Obviously, you start investing with a certain objective in mind, with a certain process. But as you move forward in your career, you do a lot of mistakes. And one thing is, at least I tell my people, is that, you are allowed to do a new mistake every day. Don't repeat the same mistake. And as you make more and more mistakes, your process becomes to that extent tighter and tighter. So I think after having learned over the last 20, 25 years, and the learning still continues, I would still say that all of us are still learning, and that is what keeps us going. I think we have developed a framework which we call the MEETS framework. And I think that becomes a hallmark for all our equity investments. So, M obviously is management, very cliched word, but my definition of management is not only qualitative, but I rely a lot on the balance sheet aspect of it. And cash flow, like a true Marwadi, becomes a hallmark of it. It's more profit earned rather than profit shown, which is basically the determinant. Then comes the earnings part. Over the last couple of decades, I have made a mistake of buying very, very deep value stocks. But if there is no growth, then the deep value stocks continue to be deep value. So there has to be a growth, and therefore we'd like to invest in companies where there is a visible 14-15% earnings growth over the next 4 or 5 years, year after year. The third is more an evolution as we move forward, the events, trends, and disruption. Life has become very different. You could buy earlier stocks for 30, 40, 50 years. Now you have to monitor them maybe every 6 months, 1 year, because something or the other would have hit their business models. Even in the pandemic, the way we live, the way we work, the way we study, the way we are having conferences, the way we eat, the way we consume, entertain, has all changed. And therefore, for any stock, I think one thing which we keep on mind is the disruption part. The fourth is a timing. You can't time the markets, but I think if you are disciplined, the concept of mean reversion does help. And if you are patient, you will be able to buy stocks at your valuation metrics. And the fifth is some structural plays will have to buy it a little expensive. So this becomes a framework. In terms of stocks, I think typically what we have noticed is that companies which can over a period of time, generate earnings growth are the ones you have to back. Now, whether they are consumer stocks, whether they are some commodity stocks, all that is factored in. But one thing is very clear: as long as there is reasonable growth and you have bought them at a good price, you will end up making money. I think to start with, I would say that would be the whole mantra of stock picking for us.
Very interesting. Samit, same question to you. What are your key pillars of your stock picking philosophy?
Okay. So first of all, thank you so much, Vinay, for having me and the kind words. Also great to be connected through this medium to all the participants. Yeah. See, Vinay, I think again for us, similar to Sunil, earnings growth is the core. Earnings growth is what generally delivers you the returns. You can't really analyze the valuations, with any kind of science, but at least you can study a business with a lot of science and with your experience. Understanding a business, accumulates over a period of time. When you look at hundreds and hundreds of businesses, that understanding improves. Right? So for us, the core is always the earnings growth. We look for companies which will double their earnings in the next 3 to 4 years. Of course, it's an aggressive target, but that's what we try. Otherwise, you can't get the kind of returns that you look for. Now it's easy to say that earnings growth is what we look for. Question is, how do you do it, right? Execution is one of the most important thing. Like execution is one of the most important thing in the companies that we look for. Also, it is similarly important in our business, right? So one good thing that I think is available in India, a lot of companies, very few companies are able to grow without spending on CapEx. So CapEx comes first and then comes the growth. So I think it's important to understand so I'll give an example. I mean, this is not a recommendation, or just so that I can explain the process a little better. Let's take an example of a Deepak line, right? They already had a specialty chemical business, a commodity chemical business. they introduced and they planned for a new big capex for a phenol division. Now your job is, because when they are almost more than doubling their gross block, there is a potential for growth. Your job is to analyze what exactly and how would they be able to execute, because you can put up a capacity. Main thing is how do you sell. So at that point, phenol was mostly imported from China and other countries, right? So then your job is to go talk to the distributors, to the supply chain, and understand exactly if you are going to get phenol from India, what is the advantage? That's where you realize that there is a logistics cost, there is a storage cost, and if you are getting it from local supplier, a lot of those costs go away if you are getting the same kind of quality. Now, this kind of analysis differs depending on the business that you are looking at. You need to know what exactly are the drivers behind growth, and you have to analyze those drivers and also look at the sustainability of those drivers, right? So, those are the kind of things that you need to do. So I know it's difficult, but at least the one good thing is growth will not come without capex, and capex something that you can rely on, and at least you can study. The incremental return on that capex is very important. You don't want the company to go for the lower value-added products and go for lower profitability. You want the company to go, up in the value chain. So one other good thing in India is that whether it's a Deepak Nitrite or PI Industries or Balkrishna Industries, market gives you a lot of time, because no one is sure. Whenever there's a big capex announcement, many a times, whether even in the case of Balkrishna Industries, the stock corrected.Ame thing happened with Deepak Nitrite, and same thing happened in 2011-12 with PI Industry. So if you have a better understanding of that business, you definitely get an edge, and you get a lot of time to enter the stock. I mean, sometimes the production start, and you can actually talk to the distributors and actually see the product getting sold, and after that the stock is still available at really cheap valuation. So I think that's what we try to do. We look for higher growth. Since most of our companies are into B2B segment, you do get opportunity to analyze the growth, and it's all about execution and how you understand the business. There is no easy work other than deeply understanding each of the businesses that you are entering. That's what protects you from a big downside. That's what protects you from getting into a value trap, and a lot of those where you definitely get hit on the performance.
Very insightful from both of you. I mean, especially the point on the capex. Now, Philip Fisher, who was considered one of the best writers by Warren Buffett. So Philip Fisher had said that the best time to enter a stock is not when it announces the capex, but when that capex is coming online. Because a lot of times there are going to be problems getting those plants working back on track in a fine-tuned manner. There are going to be execution delays, and those bad news will cause stocks to correct. And once that additional gross block begins to generate revenues and profit, a stock could see a really very good growth. So, Sunil, you mentioned about reading of balance sheets, and I've personally heard your interviews, how you read hundreds of balance sheets and annual reports every year. I mean, you gave us some very interesting insights in one of the lectures that you did for us and my research team a year ago. So I was just wondering, just for our viewers here, can we drill down a bit more, and can you throw some more light on what do you exactly go about reading in the balance sheets in terms of the business strength, and what are the pitfalls that an average investor should look to avoid when he's going through the annual report of the company?
I wish I could cover everything in the 4-5 minutes which you expect me to answer. I do a course at Flame for the last 6-7 years, and I've still not completed the whole balance sheet, because I just take one topic every year and focus on it. So, see, balance sheet is I would say a very important document and a very, very vast document. Unfortunately, last 4-5 years, a lot of data which used to come in the balance sheet is now no more mandated. Otherwise, earlier you used to even get quantitative details of raw material costs, about finished products, and so on and so forth. Now, for a variety of reasons, companies are not supposed to give that. Otherwise, it was a fabulous resource. But having said that, if you read balance sheets regularly of a company, you sort of create a trend in your mind. If you just read 1 year's balance sheet, maybe you might understand something, you might not understand. But if you're reading it for the last so many years, you start to create a trend. Now, balance sheet has multiple documents. One is the written documents, which would be the director's report, and then the management commentary, management discussion. There, the management usually gives a lot of inputs on what has happened over the past year and what they're likely to do over the future years. That's very important. Then there are some hidden disclosures in the terms of technological absorption, forex data, things which they have done to introduce new products. That forms a part of the director's report. You get into the details, you have the auditor's report, any disqualification, qualification, whatever the disputes and so on and so forth gets covered in the auditor's report. And then you have the main balance sheet, which is a P&L, balance sheet, cash flow, and the attached schedules. And then the note to accounts, which again would contain a variety of important disclosures, particularly the contingent liability, related party transactions, and so on and so forth. So it's a plethora of data which is available there. As I said, just reading 1 year's balance sheet might not be that important, but if you have a trend, it will help you. And I'll just pick up on your comment on CAPEX, which Samit started, and then you added about Mr. Fisher that the right time to buy is once the production has already come into play. But maybe the profit has not come into play. Now it is very, very obvious, suppose you do 1,000 crores of CAPEX, it will get reported in the balance sheet. You will borrow maybe say 600-700 crores, you will capitalize it. The year the company gets into production, both the interest and depreciation charges are hit and the revenue is not fully reflected because it takes time for the company to come back into full production. I think if you read the balance sheet, you immediately recognize that the interest cost has gone up and the depreciation has gone up, but the sales might have not gone up in the same ratio, in the same proportion in that year. So you can deduce that aage chal ke, if you go forward, you will have an additional sale at the same sort of cost. Then there are some qualitative aspect. Board, for example, I get very enthused when a promoter has and I'm not trying to be a little bit gender biased or anything of that sort, so please forgive me if I sound like that, but I get very enthused when the wife or the daughters of a promoter are on the board, because then the intent is not of cheating. Then there are multiple other things. Sometimes a company has some 30 bankers. I don't know why you need 30 bankers. Unless the 1 or 2 bankers are not able to satisfy your needs, then only you'll go for 30 bankers. And if you see some of the EPC companies will have 30 bankers. That means, they're borrowing from wherever and whoever is able to give them. So there are some qualitative aspects to it. But as I said, it is very difficult in 5 minutes, 7 minutes to give a perspective. All I can say is that any analyst, if that analyst wants to be a long-standing, consistent and well-rated analyst, cannot ignore this basic document, which is a balance sheet.
Wonderful. So, Samit, what do you look at in the balance sheet?
Yes, so again, it is it's too big a topic to cover in few minutes. But yes, since there is a focus on CAPEX, I think return on incremental capital, not just the one they're going through, but also historically how they have delivered. Return on incremental capital, I think it's extremely important. That shows the ability of the management to understand the growth opportunities, at the same time maintain the profitability. So incremental return on investment or incremental return on capital, something that we try to calculate for especially the manufacturing oriented companies. So again, of course, a lot of times the denominator, which is the profits, is the book profit, but you need to make sure that it is supported by cash. So you got to go through the cash flow and make sure that the cash flow generation efficiency is pretty high. Generally we look for the cash flow from operations divided by the net profit to be at least 70%. Over a cycle, it won't be every year, but over a cycle, it has to be at least 70%. Otherwise, you would have those 2008 kind of 7-8 kind of period when there was huge P&L profit, but nothing really was collected later on, right? So return on capital plus, it's important to also look through the historical balance sheet, because from a qualitative perspective, you understand what the management was planning and how they have executed. Sometimes the management is they are just stock market friendly. They announce a lot of things, but never really delivers. So those are, you want to stay away from, because credibility and execution capability is something that you are trying to assess. Not only talking to management, but also through their history of what they have done. And yes, the intercompany transactions, those are important things. See, I think one good thing which is available these days in the market is you have a lot of databases. A lot of the things where you had to do a lot of hard work analyzing through the P&L items as well as balance sheet items can be done in a matter of minutes, because there are Ace Equity kind of software, screener kind of softwares which help you do that. So it's good to have templates, because it saves you a lot of time, and you can run through a lot of balance sheet, P&L, cash flow items in a matter of minutes to basically throw away a lot of companies you don't want to waste your time on. Otherwise, physically going through so many companies, because when you're analyzing a company, it's not enough just to analyze that one company. You need to understand the competition, right? And if you have to go through 10 companies and their 10 years of history, it's physically impossible, because it's one of the most inefficient way of doing. I mean, you will be buried in those balance sheet. So it's important that whatever can be automated has to be automated, and whatever cannot be automated is something that you go and dig deep onto the balance sheet.
Very sharp points both of you make. I mean, the red flags like 30 bankers, especially if the company is not large enough. I mean, these are clear giveaways. Now, one of the sayings in the market is that in stock picking, we discuss a lot about company fundamentals, and if you get the company right, you make money. But the real wealth gets generated when you get the sectors right as well. Now, for each of you, how do you delayer and analyze the sectors to be in, both from the entry point of view, and more importantly, which ones are the ones to be avoided, especially if they are too cyclical and so on? And do you have any view what looks really good as a sector with a next 3 to 5 year perspective?
You want me to start first?
Yes, sir, please.
Okay. So, I think at least our investing thought process is that every company and every sector is worth a look, and we don't ignore any sector and any company. Obviously, going by the screener kind of approach which Samit mentioned and our past history, you end up knocking off few obvious companies you don't want to look at. However, see, we are in this business of investing and creating a good, stable portfolio of good stocks. Now, there is a difference between a good stock and a good company. A company can be the best company, but if it is priced beyond perfection, it is not a good stock. And I think that is what our philosophy is. So, we all know that India is a huge country. India has so many people, and it's a growing economy, and standard of living is improving, and so the consumption will rise. But if stocks are trading at 70-80 PE multiple with 10% growth, even though we are positive on the sector, as investors, we don't find any merit. So I think why I'm trying to mention this is that it is not only about your view on the sector, but it has to marry with the valuations or the growth which those companies or the sector are discounting. And therefore, from our perspective, from time to time, even commodities become an exciting sector. See, we have cycles like the steel sector, it's moved up like so sharply. And it is such a simple thing. Every 4-5 years, you go through a cycle where no one wants to touch them. And then suddenly everyone, after they've moved up 3 times, wants to chase them. So, if you have seen that, I think the only thing you have to do in these sectors is pick the best company whom has survived last 30-40 years and will survive for the next 30-40 years. And you will make a lot of money. I think, again, what I'm trying to say this is that every sector at some price point and in some cycle will become interesting. At this point of time, frankly, our view is that India is moving very fast to what the world has already moved, which is the digital economy. Unfortunately, in India, there are not too many companies which are listed. And to that extent, the Indian investors have been deprived because of, I would say, over-liberalization, where the Facebooks and the Googles and the WhatsApp and all of them have got the valuations what they have because of Indians consuming their products, but we have been deprived of it. So, however, there are companies which are getting listed gradually. Wherever you get a good company or a set of companies where you are comfortable on their business model and they're not very expensive. You will not get them at 1020p. You'll have to buy them at 3040p, unfortunately. But if you believe that the segment is such where the growth can be high for a long period of time, I think digital economy is something you cannot ignore. And then you come to some other sectors. I think financials globally is going to be there forever. You just can't take away the fact that for everything we do, we need banks and financial services. The only thing, again, there, the delivery of that financial services might change. And there can be disruptions even there. So I think forward-looking financial companies, which have a good brand name, because ultimately it's all about liability franchise, they will again be great sectors. Consumption, again, we are not negative per se, but the only thing is we will maybe wait for valuations to be slightly better. And then, you have sectors which India has unique advantage, which would be the IT sector and the pharma sector, and to some extent the new age sort of, I would say quasi-pharma sectors like specialty chemicals and so on and so forth. I think India has an advantage there and they will have to do well. I think all the other sectors are also very large in India. So from time to time, there will be opportunities in the auto side, on the engineering side, on maybe the cement side. So the good thing is there is so much to choose from. But the sectors I mentioned is some sectors where maybe from a near-term perspective would be quite positive.
Interesting. So your thoughts on digital economy? I know you own Root Mobile in your portfolio, if I'm not wrong. So I think your thoughts are short. Samit, same question to you. How do you delayer the sectors and what are the ones which you would not touch and which are the ones which will find favor with you?
Sure. So, see, we are completely bottoms-up stock people. I mean, it's never that, if we are excited about a sector that would want to just position ourselves in that sector. There has to be at a company level, traction which is already picked up. So, like specialty chemical is something we have invested over the last, since the start. It's not because, I had any insight into that this sector is going to become, such a big sector. It's going to have such a fabulous runway over the next 5-7 years. It's just that you could see companies already delivering 20-25% plus kind of growth. They were putting capex at that point in time. I mean, Aarti Industries and SRF and a lot of those Vinati, they were all putting up capacity. Their margins were improving. AI Industries, and no one was really valuing them. Right? So I think it's better to just, rather than take an investment call based on a macro view of a certain sector, just to see where the real action is. And as I said, and as you also mentioned about Mr. Fisher, is that you do get time. I mean, once the production starts, market does take time to really assess the value that this sector is going to create. So right now, if I have to give you a macro view, so historically, specialty chemical is something which has worked out, and I think it has a long way to go. One major change which I think has occurred in India is that even though economy may be sort of at a bottom, just look at the balance sheet of corporate India. Leave out the top 100 companies, just look at the next, say, 1,000 companies. I think the balance sheet today is one of the best in the last 20 years. I would say this from a perspective of cash flow generation as well as debt to equity. The debt to equity ratio for this broader markets, used to be almost 1, 10 years back or 15 years back. Today it's gone down to 0.4. The median debt to equity today is 0.4. Right? Even if you look at the interest cost as a percentage of sales, it has gone in the early 2000s, at the start of this century, it used to be 3% of sales. Today it's close to 1% of sales, and it has drastically come down. Right? So the biggest hurdle for our growth has been that there was no credit growth available. So there was banking issue, the banking cleanup was going on. At the same time, banks were worried about who to lend to because the balance sheets were very weak. I think both of those things have changed. Banks have improved their balance sheet. They have raised a lot of capital. They have provisioned for a lot of the issues they have had over the last couple of decades. And now I think they would be much more comfortable lending to a lot of these broader market companies. And if you look at even the last couple of months of trend, you would not have noticed any kind of downgrade of debt. Mostly it's been upgrading of debt. So you are sitting on at a time where I feel the capex cycle is going to pick up, right? And you have incentives from the government, which is the PLI scheme, as well as there is a 15% tax rate for new manufacturing capacity to put up. And again, that has a limited time, like you got to commercialize by March 2023. So there will be construction of factories, there will be construction infrastructure just because of the financing which is available. Interest costs have gone down and there are short-term triggers. So I think building material could be one of the big sectors which could benefit. Question is, how do you play it, right? I mean, either you can go it through a very, very commoditized way of playing a cement or steel, but then you need timing in that. Our ways would be to look at more structural way of playing it, right? Where even during the bad cycle, those companies should be doing well, and if they get a good cycle, they will be doing even better than that. Right? So you try to find such building material niche companies where they could be sort of semi-brands, and they will have a huge and plus most of them have become debt free. They have 30-40% unutilized capacity, so there is a benefit of operating leverage. And if they want to expand further, I mean, the cost of debt for them has gone down so much. I mean, in India's history, I haven't seen a period when the inflation is 7% and the working capital funding today for most of these companies, even the smaller companies today, 3.5% for a 90-day commercial paper. So I feel the capex cycle has to pick up after a long gap of 10 years. And I would bet on sectors which will benefit from this.
Very interesting points you make. Now, I think on the chemical side, it was clear to a lot of people that there was a clear value migration which was playing out for last maybe 7, 8, 9 years. I mean, the book Adrian Slubotsky wrote on value migration, the chemical sector and the specialty chemical sector kind of played that completely by the book. And that's what has exactly happened in the last 8, 10 years. Very interesting insight on the capex cycle, Samit. Now, Sunil, I remember your team writing a paper almost about 2 years ago on what was happening with respect to market leaders, especially on the consumption side, where the earning growth was significantly lower than what the price growth had been over the last many years. And the paper was hugely debated and very well circulated in the stock market. Now, it's kind of becoming a trend, buying market leaders at every price. So does this kind of strategy really make alpha in the long term? and how should you play this?
So one is we released that paper towards the end of October last year, just 2019. And see, what is stock investing? When you invest in the equity of a company, you basically become a partner in the business. That is the whole logic of investing in an equity. Depending on your percentage holding in that company, you are to that extent a partner in the company. The other thing is you'll become a partner in a company if the future profit justifies the upfront investment which you are making in that company. So what we did was, we saw that there was this huge move towards, I would, it would sound a little rude, but this was dumb investing. That we were investing in companies because of the perception that these were good, clean, well-run companies, which might be a fact, and someone else would come and buy it higher than you. You're not buying it because the future cash flows would justify the price which you are paying. So if you go by the historic or the traditional way of investing in equity, the outflow which you make right now in terms of the purchase cost has to be justified by the inflow of all the future cash flows which you expect from the company. And we then dug deep. So versus the general perception that some of these companies which are trading at 70-80 PE multiple would be growing at 20-25% CAGR, we found out that most of these companies over the last 10 years were growing at like 7% to 11% CAGR. And mind you, the notional or the nominal GDP growth, the nominal GDP growth of India over the last 10 years has been 11%. So it was a challenge for most of these companies to even match the nominal GDP growth rate of India. And a lot of these companies were growing and still continue to grow below India's nominal GDP. And yet they were trading at anywhere between 60 to 80 PE multiple. Now you fast forward. For an investor to make a 10% return in a company over the next 10 years, the company growing at 10% means that the PE multiple, which is right now 70, has to continue to be 70 for the next 10 years. Nowhere in the world have we seen any instance where companies trade at 70 PE multiple for 15, 20 years in succession. There has not been even a single company which has traded at a PE multiple of more than 70 for 15, 20 years, except a few companies in India. Also, the returns which these companies have given over the last 2 years have been only because of 2 days. One was when the finance minister reduced the income tax on corporates. That day you had a pop of 20% for most of these companies. And second was recently when MSCI changed its rules and a lot of these companies got added into the MSCI index or had their weightages increased in the MSCI index. If you remove these 2 days or 2 instances, these companies have given no returns over the last 3-4 years. So my view is that these are great companies, absolutely no doubt about it, but they are priced beyond perfection. And for you to make even 10% return, these companies' PE will have to be 70, 80 for the next 10 years. Then there is a third angle to it. A lot of these companies are subsidiaries of global multinational companies. Now, a consumer durable company in India, which is 75% subsidiary of a US major, traded at a PE multiple of 80 times. A $3 billion market cap and $40 million of net profit. The parent traded at a PE multiple of 6 times. And if you remove the valuation of the Indian subsidiary, the parent traded a multiple of 3 times. Interestingly, the parent was also growing as fast as the Indian subsidiary. So last 1 year, the Indian subsidiary has given 0 return and the parent has doubled. So for a foreign investor, they will come to these companies only if looking at the vast potential of India, these companies grow faster than their foreign counterparts. If the growth rate is the same, if the ROEs are the same with a higher cost of capital in India, why would someone pay a 70 PE multiple in India and a 15 or a 20 PE multiple overseas? Pfizer in US, despite having the patent of manufacturing the vaccine, trades at 15 P multiple, and Pfizer in India, which is just a trading arm, trades at a P multiple of 70 times. तो हम तो दूर से नमस्ते करते हैं सब कंपनियों को सर.
Terrific insights, Sunil. And I think your paper also spoke so eloquently about this when you wrote. Samit, what are your thoughts?
Yes, I mean, Sunil has put it so beautifully. I don't think I can add much to it, and I completely agree with his point of view. And I had presented at CFA conference in Delhi in 2018. On the similar lines, that I had showcased that these consumer and the market leading dominant companies, if you look at until 2011, they were all trading at similar valuation to what Sensex trades at. 20-25 times trailing multiple is what they used to trade at. Post 2011, what happened was the growth from the rest of the economy just vanished. That's where all these scams started, and Congress, they were all paralyzed. There was nothing which was passed in the parliament, and then BJP came in and the cleanup started. And during that time, the credit growth and hence the overall growth of non-dominant companies, the broader market, just collapsed. It fell from that 13-14% historical trend to almost just 5-6%. If you look at just the BSE 500 growth rate, you'll get an indication of where the growth has been. And that's where these consumer-oriented companies continued delivering that 10-11%, which was significant alpha for a lot of these FIs with consistent. Whoever keeps on growing in a really bad cycle, tends to get crazy valuations. That's what you've seen. I think that's where the entire money, got migrated towards these kind of companies, and that's the returns obviously has come mainly from the P multiple re-rating. They used to trade at 20-25 multiples. Today they trade at least 2 to 3x of that, right? But from an investment perspective, I think, how do you define a market leader or a dominant leader, right? So, for example, Balkrishna Industries. In India, it is the largest off-the-road manufacturing company. But do you really call it a dominant leader? I mean, they are nowhere compared to a lot of the larger tire companies in the world. But in an Indian context, you will call it a dominant leader. I think what matters is, are they dominant enough? Are they disruptors where they are taking away market share from the rest of the competition? That's what I would call a leader, because that's what really matters, right? If you're looking for significantly higher growth than the market, the only way it generally happens is by when they're putting up capacity. Most of the industries don't grow at that 20 to 25% rate. They can only grow at that by taking away market share. Either you take market share from the domestic competition, or if you're an export oriented, you are taking away market share from some other players, which could be even more dominant from other countries. So I think it's important that you analyze what is the disruption that this company is going to create. Balkrishna manufactures their tires at half the cost of any other global player, right? So it is able to provide at, even if it's selling at a significant discount to these prices, they are making significant profit. And they are the disruptors of a lot of global players. I mean, look at Titan International in the US. They are almost going bankrupt because Balkrishna kind of companies are creating disruptions and they're taking away market share. So I think the leadership comes from some kind of competitive advantages which are so superior and sustainable compared to the others. I mean, another example is in 2012-13, Exide used to be the most dominant player, right? But Amar Raja, with partnership with Johnson Control, they had the most modern plant with the lowest cost of production, and they targeted, the replacement market where they could offer their battery at 15-20% lower price. They took away that market share. I mean, Amar Raja went up 5x. The dominant leader was flat for 5 years. Right? So you got to understand the company's competitive advantages, how they're differing from anyone. It could be a global leader or it could be a domestic leader. But market share gain has to be there. Otherwise, just growing at 10-11% with the entire market as their, with a very high market share already doesn't mean anything for an investor.
Very interesting, Samit. Now, to both of you, and just a kind of a offshoot of the previous question, if I may. And that is now, Samit, if I may come to you first now, you've mentioned in one of your interviews that you've added stocks at 6 times the price also of the first time when you bought it. Now, in a scenario what we just discussed, how do you decide that the stock is the current winner from the current level? And do you have any strategy or thinking around when to exit?
Right. It's for me, right, Viren?
Yeah, it's for you, Samit.
Okay. Yes. So, see, your entry point should not be a benchmarking for your buying into the stock at any point in time, right? So there could be stocks which go up. So, for example, Bajaj Finance, we bought it in say 2010. From there, it has gone up more than 115x. From there, your analysis is a moving, it's almost like a moving ball, and you got to look forward. And looking forward, if you think that they are going to double their earnings in the next 3 to 4 years, and you are still comfortable with the valuation, you keep on buying them. I mean, it doesn't really matter, what has happened since you bought first. So, because it's a very tricky situation for a fund manager, like especially a PMS fund manager, right? Because who keeps on getting money at every point in time. Just because my first client bought it in 2012, in 2015. If I find it interesting for a new client, I'll still keep on buying it. So the evaluation remains the same, and from that point going forward, if it meets your criteria, you buy it.
And how do you do your exit strategy? How do you decide that no more juice and time to move on?
Right. No, exit is extremely difficult. See, one indication is that once the growth starts slowing down, mainly, the opportunity size plus capex is not coming, you get an indication that it's almost impossible to provide that 20-25% kind of rate that you are looking at. Right. So if that is your investment philosophy or that is your investment strategy, that is an indication that you got to exit because it's not delivering what you are looking for. That's one. But I think the tricky part comes in when there are sometimes a couple of slow quarters. Just because they have had a couple of slow quarters doesn't mean that it's permanently damaging their long-term growth prospects. And see, I think the biggest mistake that fund managers tend to make is early exits. Right? So if you are looking for long, huge multi-baggers, where the stocks go up 5x, 10x, sometimes 100x, you will have to bear with some of your laggards, which may not deliver in the next 2 quarters or 3 quarters. And just keep on evaluating deeper whether it's something which is really short-term in nature or long-term in nature. If you realize it's something which is permanently changed, you just get out. I'll give an example. We invested in Kaveri Seed at that time, and an investor for 5 years. It was a big multi-bagger. One fine day, Maharashtra government comes in and says, we are going to cap the price of cotton seed and plus reduce the price of cotton seed by 100 rupees per package. That's a complete structural change which is going to destroy the business model itself. With that change, you just exit right away. So there will be, if you understand the business well, you will know if there are changes which are happening around it. There could be some other disruptor, there could be regulatory change, which just destroys your investment hypothesis. And if you realize that, you get out. If nothing has changed, it's just that they have had a couple of slow quarters, it's better to give them some time, because nothing is going to go up in straight line. You will have bad times, you will have tough, few quarters, even 1 year or 1.5 years. But if you're looking for a 10x and 15x kind of returns, it's fine if the stock goes down to 0.7x or 0.6x, but you can afford that 0.4 for getting that 10x.
Sunil, same thing for you. How do you decide whether it's time to move on from a stock and exit?
See, again, I would agree with Samit that it's a very difficult, thing to do. Frankly, a lot of times the investors do ask us that when you buy something, do you have an exit target in mind? And I would agree that this is a floating or a ever-changing kind of a target. So for us, there are three reasons why we exit a stock. One is if we go wrong. So the moment you realize that your hypothesis is not working for XYZ reason, it might be government intervention, it might be some things changing for the sector, some things changing for the company, things changing in terms of our perception about whether the company is fair or not. That is the first signal, and you just get out, because the more you delay accepting that you have gone wrong, the more will be the losses. The second reason, obviously, is if some stocks move away much beyond your wildest expectation. And that again is a very difficult thing. But taking the same example of Bajaj Finance, I was one of the earliest investor in Bajaj Finance, maybe the first institutional investor in 2008-9. And it was a very difficult period because it was coming out of Lehman. And within 2-3 years, we had tripled or quadrupled our money. And at that point of time, to make any money was like a lottery, And here we had multiplied our investment to 3-4 times, and we exited. And I think between 2011-12, we just exited everything. And from there, it again went up maybe 50-70 times, and we just were not able to buy it. It's very difficult. But what I'm trying to say is, if you feel that you have, the stock has run up much beyond your most optimistic expectations and discounting maybe 4 or 5 years ahead, you just sell it. Sometimes you might go wrong in your assessment of how fast the company can go for how long. So in Bajaj Finance case, at least I did not expect the company to grow at 40% CAGR for 10 years, but it happened. You might go wrong, but it is fine. If you feel that the stock has moved up much beyond your fair expectation, you get out. And third is capital is scarce. We are not in a scenario where we are the sovereign wealth fund and we just have to invest. We don't have to exit. There are opportunities which keep on coming. So the third reason we will exit is if we have something which is much more a better opportunity than something which we already have in the portfolio. So these are the three reasons why we would sell a stock, frankly.
Very thoughtful. Now, one of the challenges I think that almost all investors and fund managers face is between what is buying right versus what will generate a short-term alpha. So, how do you do this? Is it a consistent philosophy that you will stick to, or it will be a need-based change in approach in line with what market is dictating? So, Sunilji, first to you.
See, again, it is very tough and very difficult, because in my 20-25 years of investing, I think the scenario changes very dramatically. So maybe 2-3 years back, being debt-free would have been a virtue. Frankly, I would agree with Samit when he started off. I would say that companies who have demand for their products, which entail them to increase capacity, should do it now, because debt in India was never so cheap. So if you set up capacities now and you have demand and you can manage it, I would back companies which are in the midst of capex. But it might change. Suddenly, maybe in some times you might want that risk is very high, and we would like to be in companies which have less debt, so that even in the worst scenario like COVID, even at 30-40% capacity, they will end up sustaining some profit. They might not make huge profits, but they will end up making some profit. So I think this changes from time to time. Between 2003 to 2008, the biggest money and wealth we created were backing companies which had huge capex plans. Because equity was available like never before. Debt had gone down dramatically. Rupee was appreciating, so you could borrow overseas and at almost zero cost. That was a time. Post Lehman, the thing completely changed. Equity became scarce, debt became very expensive. So I would say that things change. However, one thing which we have realized after so much of so many mistakes, is that ultimately you have to keep the basics right, which is back promoters who are fair, because a good promoter, even in a challenging sector, will ensure that you'll make some money. Obviously, to buy a good promoter in the best sector is a dream, and it doesn't come cheap. But even if you have a bad sector, but a good promoter, that promoter will ensure that the company will sustain, and when the time turns good, that promoter will make a lot of money. So I think it's a moving kind of a thing.
Samit, what are your thoughts?
Yes, I mean, see, there's really nothing, anything like a right thing to do in investment. So, as I said, capex doesn't always mean that they have to borrow a lot of money, because generally, if you are making ROC of upwards of 20 to 23%, that's the growth rate that you're targeting, right? So that generally should be self-sufficient. Internal accrual should be self-sufficient for that kind of a growth rate that you maybe for a short time you might have to borrow a little bit until the production really starts. So for us again, it boils down to the earnings growth, and there one is, as I said, capex, but another one, I completely agree with Sunil. I mean, my experience, especially over the last 15 years in India, has been that markets are so dynamic, industries are so dynamic. You just can't take a long-term view. Even 5-year view is very difficult. It's a moving ball. You just have to keep on evaluating the business every point in time, because anything can happen at any point in time. So there could be trade barriers, there could be regulatory changes, there all sorts of things can just come out of the blue. What you can bet on is the executing capability of a promoter. That doesn't change, because if you have a very competent, dynamic promoter with the right integrity and the right intention for the business, generally comes out of any kind of a problematic issue much stronger, and that's what you want to bet on. So you could see that during this COVID crisis. I mean, there are so many companies who are 2x or 3x much stronger today than they were 10 months back. So I think it's all dependent on what kind of the pilot is at the driver's seat.
I think we are almost at the end of our time, and one last quick question. So I was chatting with Mr. Naren yesterday, CIO of ICICI. Now, he said that he had some very good experiences from Harshad Mehta scam and then Asian crisis of 1997. And he spoke a lot about his learnings from those crises. Now, given the experience that what both of you have had over multi-decades of your investing in the market, can you share some experiences on your investment history which can help a young budding investor in the market? Sunilji.
So, frankly, I have also learned from the Harshad Mehta crisis. I was a very, very young investor and a very small investor, and I did not sell a stock. I was a practicing chartered accountant that time, and I was too much into taxes. And I did not sell a stock in March of 92 because I would have to pay taxes, and I thought I would sell it in April so that I could then worry about it the next year. And unfortunately, the market did not open in April because of the SEBI related strike. And then the stocks just opened at 50% of my cost. So one is don't worry about taxes. If you make money, you pay your taxes. Second is, I think over a period of time, what we have learned is that ultimately, you have to focus on your strengths and focus on fundamentals. And never buy something because something else in that segment has become too expensive. This relative valuation, sometimes I get very scared. So in the dot-com boom, people looked at Infosys and TCS was not there, but Infosys and Wipro, and ended up buying software solution or Square software. Everything fell, but Infosys is now much higher than the 2000 levels, and Square software and software solutions don't exist. So, this relative cheapness does not work. You have to look at the companies on their own merit. And the third thing is nothing lasts forever. Good times don't last forever, and at the same time, the bad things don't last forever. And this year is a true indication of that. In March, we thought that it is the end of the world. People are talking about Sensex becoming 7,500, not Nifty. And here we are, we are talking about Nifty becoming 40,000 and not Sensex becoming 7,500. So, nothing lasts forever. I think good times don't last forever. Bad times don't last forever. So be rational, be focused, and just focus on what you think you are good at and focus on the basics. And our tagline, therefore, is believe in the basics.
Great. Samit, what are your learnings?
Again, like balance sheet, this is also a topic which can last for hours. So again, I think the biggest problem for an investor is your ego, having to prove yourself right. So even if you internally know that you have gone wrong in the thesis, just because you have publicized yourself into that, into some investment thesis, you want to make sure that you don't get out on a loss, So I think that's the trap that you tend to face, especially fund managers, because of the public exposure that they have. And it's a new learning for me too. I think as soon as you realize, irrespective of how, wherever you are, whether it's at 30% loss, 40% loss, just get out. As when you analyze capex, I would say it's much easier to analyze the demand side because you can do a lot of study. It is not that easy to analyze the supply side. Supply side can just crash the profitability of a sector. And that is something that very few investors tend to focus on, and what can happen to the supply side, because depending on the supply in that industry, and depending on whenever there is a mismatch of demand and supply, how the other competitors behave is so irrational sometimes, and you can't predict how that happens. And take an example of Sterlite Technologies, right? It's one of the thing where I was very positive in terms of last 4 years, double the earnings. But I started buying at 100, it went to 400. From 400, it's back to it went to 50, and then now again back to 160. So you go through these wild changes. But then 2 years ago, you realize that the demand side is slacking off. But it was very difficult to know how the supply side will behave during that time. But as soon as you realize that the supply side is completely behaving irrationally, it's time to exit. It's better to watch the movie from sitting outside rather being part of that movie. Because it's not fun to go through the stock market rides. Those are only fun in Disneyland, not in stock market. So I would say those are the biggest learnings for me.
Very interesting. So I know on Sterlite Optics, we've discussed it many times in the last few years, and luckily we gave it a miss, but that was more of my analyst call rather than my call. But yes, we are lucky nevertheless. Wonderful 1 hour spending with both of you, Sunil and Samit. I've had a lot of learning, and I'm sure our viewers would have gained a lot. Thank you once again for your time. Thank you so much.
Thank you.
Thank you.